interest rates were going up, meaning it was more expensive to borrow money. And now you had venture capital firms and these institutions looking for profits. And that's when they started to realize that a lot of these tech bubble companies were not able to secure a profit. They were not able to cut their costs and raise their revenues fast enough. And so we were starting to see the economy slow down in 2018. So the bubble was starting to burst. And people were getting very worried about what that was going to mean. Were we going to go into a recession? But then in 2019, President Donald Trump at the time really put a lot of pressure on the Federal Reserve Bank to avoid a recession. So what did they do? Well, the Fed started cutting interest rates. This is before the pandemic. So now the Fed starts flooding the markets with more cheap dollars because now you had this bubble, the air was starting to come out, but then the Fed turned on the fan and they started cutting interest rates, even though, if you remember back in 2019, we kept hearing about how we were in the strongest economy of all time. If we were in the strongest economy of all time, why would we be cutting interest rates? You cut interest rates typically when you're in a recession as a way to boost and stimulate the economy because it creates more inflation. So it's a way to stimulate a slowing economy. And we kept hearing that, hey, we're in the strongest economy of all time. Yet here at the same time, we have the Fed working to stimulate the economy. That's what I was talking about in 2019. And so now the Fed's cutting interest rates and now the machine turns back on. More money is being injected into our economy. And now the venture capital firms, the institutions are saying, oh, now we can make even more risky investments because we can borrow hundreds of millions, if not billions of dollars for super cheap. Okay, and that's exactly what happened. So now more money starts going into these companies, and then comes 2020, which was when the economy shut down, and now everybody is spending time on their phones and their computers because no one's going to work and you're stuck in your house. And at the same time, the Fed also starts cutting plus quantitative easing. So now they're handing out money to corporations. They're handing out money to people. They're handing out money to businesses. Money is being printed out of thin air, being injected into the economy. And on top of that, they're cutting interest rates to the lowest amounts that we have ever seen. And now we have the biggest influx of cash into our economy ever in 2020. Now the bubble really starts to grow. And then what happens in 2020 and 2021, we saw a huge boom in these tech companies. So now these tech companies are saying, oh my God, our users have just doubled or tripled or quadrupled. So we need to go out and grow even faster. So now we had in 2021 this valuation boom because now companies are saying, well, here we were worth maybe $400 million based off of our revenues, based off of the number of users that we have. But here in 2021, we're worth $4 billion. So now companies went from raising 20, 30, $100 million to raising $1 billion because they're saying, look at how fast we have grown. This economy is not going to change. This pandemic economy where people are using our products are not going to change. And so we need to go raise money and grow as quick as possible, as fast as possible. So now companies are going to investors and they're raising money at these super high valuations, trying to grow even quicker. Now in this valuation game, you have to keep growing your valuation if you want to keep raising more and more money, because now when you're at $4 billion, the goal is to grow your users, grow your revenues. That way now you can say that our company is worth $10 billion. That way you can raise more money without giving away all of your ownership in the company. Because in the beginning, you founders are going to have 100% of the company. And anytime you raise money, you're giving away a little bit of your ownership. You're giving away a little bit of your equity. That way you can raise more cash to grow even quicker. And then what happened was 22 came and inflation now finally started to become apparent, because during this period, the Fed kept saying that money printing does not cause inflation. You don't have to worry about inflation. And then in 2022, inflation got so bad where now the Fed said, okay, we need to do something to fight inflation. So we started to see not quantitative easing, but quantitative tightening. We saw this start in June of 2022 where the Fed started selling off some of the balance sheet. And now we saw the Fed also increasing interest rates. So now it becomes more expensive to borrow money, which is the opposite of what happened here, because before your risk-free investments paid very little. But when interest rates go up, your risk-free investments start to go up as well. like your interest rate on your savings accounts, well, most of them probably haven't grown that much, but they are starting to go up. Now, of course, your savings accounts are nowhere gonna compete with inflation. However, you are starting to see these interest rates go up. And so now you have these banks and these institutions making the same investment analysis before. They're saying, well, for one, you tech companies or whatever company it is, you're not seeing the same growth that you saw before because the high inflation has been pushing the economy into a slowdown. And so because of this economic slowdown, these companies are not seeing the same growth that they wanted to see. So on the growth side, it's lower. And from an investment perspective, we need a higher guaranteed return for us to justify investing in these companies. So now all of a sudden, the banks and the institutions and the venture capital firms are saying, we don't think you're worth the $10 billion that you say you're worth. We don't even think you're worth the $4 billion we paid you last year. We think you're only worth $1 billion. And so now these companies, which have very high costs, because remember, they're not profitable, are saying, oh no, we don't have the ability to make our payroll for another 3 months. We need more cash. And so how do you make more cash? Either you increase your revenues or you lower your costs, or both. And right now, companies are struggling increasing their revenues because of our economic slowdown, which is being caused by inflation. But we have this like recession on the horizon. So companies are struggling raising their revenues, which means they're only left with cutting their costs. If you enjoyed this shorter clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to invest your money in real estate, our team put together an amazing guide on real estate investing. This guide goes over what real estate investing is, how to start using real estate to generate cash flow, and how to build wealth with real estate. This guide is completely free when you sign up for our daily newsletter. So if you want to read our guide on how to start investing your money in real estate, you can download that guide just by clicking that button right over there. Thank you for watching, and as always, keep hustling.